Back in the 1920s, a financial glitch let regular people get rich, fast. It felt like magic. It let ordinary folks control $100 of stock with just $10 of their own. An entire generation of investors was created, all of them believing that prices only go up. It seemed like a permanent road to riches, right up until the day it triggered the biggest economic collapse in modern history. Well, guess what? Almost a century later, that exact same glitch is back. It's running wild in the unregulated corners of crypto and the speculative frenzy around AI. And just like last time, the financial system is ignoring the warning signs. History is getting ready to repeat itself, and almost no one sees it coming. The market wasn't about a company's real value anymore. It was a game of getting in, making a quick buck, and getting out before the next guy. The Roaring Twenties were a decade of explosive change. The economy was booming, thanks to revolutionary tech like the automobile and the radio. For the first time, credit was easy to get, letting normal people buy cars and appliances they couldn't afford outright. This wave of good times spilled onto Wall Street, where the stock market began a climb that can only be described as meteoric. The Dow Jones Index went from 191 in early 1928 to a peak of over 381 in September 1929, nearly doubling in value. The promise of easy money was intoxicating. It sucked everyone in, from factory workers to shoeshine boys, all convinced they had a hot tip. There's a famous story, maybe true, maybe not, that Joseph Kennedy knew it was time to sell when his shoeshine boys started offering him stock advice. Stock prices were completely untethered from reality. But nobody cared, as long as the numbers on the ticker tape kept going up. It was just a fancy term for borrowing money to invest. Wall Street brokers encouraged investors, even those with very little money, to buy stocks with as little as 10% down, borrowing the other 90%. Think about that. For just 10 real dollars, you could control $100 worth of stock. As long as the price went up, you'd pay back your loan and pocket a huge profit. What could go wrong? The problem is, this creates phantom wealth. The money isn't real. It's a pyramid of debt built on one single fragile assumption: that prices will never fall. And while Wall Street partied, the real economy was quietly starting to choke. Agriculture was in a depression, wages for most people weren't going up, and factories were making more stuff than people could actually afford to buy. The market wouldn't return to its 1929 peak for 25 years. It began on October 24, 1929, Black Thursday. A wave of selling hit the market. Panic started to creep in. 5 days later, on Black Tuesday, the whole system came crashing down. A record 16 million shares were traded as everyone sprinted for the exits at once. Stock tickers fell hours behind the actual prices, meaning people were making decisions based on old news. They were flying blind into a hurricane. This is when the glitch went into reverse. These aren't isolated incidents. It's just business as usual in a system built on extreme, unregulated debt. It's a fundamental pattern in financial history that has repeated itself over and over again. Understanding this pattern is the single most important thing you can do to protect yourself from what's happening right now. If you want to get a deeper understanding of these market cycles and how they affect your money, take a moment to subscribe. We go beyond the headlines to show you the historical patterns the mainstream financial world would rather you ignore. Fast forward nearly a century, and it's like we're hearing echoes of the past. The glitch is back, just wearing a different outfit. Today, it's not just margin buying, it's the dizzying world of crypto derivatives and the wild-eyed mania for artificial intelligence. Let's start with crypto. If buying on margin in 1929 was playing with fire, crypto leverage is like dousing that fire with gasoline, and they're piling in with a fear of missing out that is a mirror image of the speculative mania that preceded the Great Depression. The story being told about AI today is eerily similar to the one about radio in the 1920s. Back then, shares of the Radio Corporation of America, known as RCA, soared from just a few dollars to a pre-split adjusted price of over $400, all based on the revolutionary promise of the technology, not actual profits. Today, we see a similar frenzy. A handful of Magnificent Seven tech stocks now make up a dangerously huge slice of the S&P 500's total value, all of it driven by an AI-fueled boom. Billions are flooding into AI, with some analysts projecting capital spending on AI infrastructure to exceed $600 billion in 2026 alone. The anxiety over an AI bubble is real, with leaders from major tech companies to central banks voicing their concerns. A sell-off in AI will drag everything else down with it. But this time around, three things make the situation infinitely more dangerous: speed, connectivity, and contagion. First, speed. The 1929 crash took days to unfold. Traders were getting information from ticker tapes that were hours late. Today, our financial system is run by algorithms that execute millions of trades in microseconds. A modern crash won't take days. It will take minutes, maybe even seconds. A flash crash can wipe out trillions in value before a human can even hit the sell button. The panic that once spread by word of mouth on a trading floor now travels at the speed of light through fiber optic cables. Second, connectivity. In the 1920s, the shoeshine boy giving stock tips was a local story, and history tells us that when it does, the money that everyone thought they had will simply disappear, because it was never really there in the first place. And in the new, unregulated worlds of crypto and private AI investment, there are almost no guardrails at all. We are running the same flawed human code on hardware that is a million times more powerful. The story of 1929 isn't just a history lesson, it's a blueprint. It shows us that any system built on too much leverage has a breaking point. It always starts with a great story, a new technology, a new era, the promise of getting rich without trying. It tricks us into believing this time is different. It encourages us to borrow against a future that isn't guaranteed, creating a fragile tower of debt. But the money is never real, and when a shock finally hits the system, confidence vanishes, the margin calls arrive, and the whole thing comes crashing down.